Hey guys, this is Emily Lopez, and today I want to talk to you about breaking down your monthly mortgage statement. So sometimes I have somebody ask me when they're buying a home, when I pay my monthly payment, is that just my mortgage, or do I pay my taxes separately? Do I pay my insurance separately? How does that break down? And then on the other side of things, every once in a while I'll have somebody call me and say, hey, I want to sell my house. And I'll say, okay, great. Let's figure out what your house is worth in the current market. But first, you know what you owe on the house, because we have to figure out if you bought in one of those times where the market was really high and really expensive, have you paid off enough where you're going to be able to sell it and pay all your fees and get out from under the house? And I'll have people tell me, well, my monthly payment is $1,200 a month, so I've been paying on it for 5 years, and they'll take 1,200 times 12 and multiply that by 5, and they think that's what they've paid off on their house. And a lot of people don't understand that that amount of money you're paying every month is not paying down your loan amount. It's going to break down into 4 and sometimes 5 sections when you pay that payment every month. So the first thing is principal. The second thing is interest. Next we have taxes, then we have insurance, and then sometimes we have mortgage insurance if you haven't put down a 20% or more down payment when you purchase your home. So the way this breaks down is as follows. Principal is the amount of the monthly payment that actually goes toward paying down the balance of the loan that you owe. That's the most exciting number because that's the one that's decreasing your loan balance every month. But when you look at your monthly statement, if you haven't ever done that before, you'll be surprised at how big the number is you're paying and how small of a number is actually going towards paying your principal. And so principal is getting paid down in that amount every month. Interest is the amount of money every month that the lender makes for doing the loan. Of course, if you're going to loan someone hundreds of thousands of dollars, you have to make money for doing that, and that's also a huge risk for those lenders. So interest is a profit that they're going to make every month. That number is going to probably be higher than the amount that's going towards your principal, especially in the earlier years of your loan payment. Next, you have taxes. Depending on your county, they're going to assess taxes. They're going to do them every year, and in my county, they get paid out. You can either pay them in one portion or you can pay them in two, and a lot of lenders pay them twice a year. So every month when you pay a payment, they're going to take what your total amount for taxes is for the year, they're going to divide it by 12, and you're going to pay that portion every month, and then they'll distribute those twice a year for you because your lender wants to make sure that the property taxes are being paid. So most lenders are going to require taxes, property taxes, to be included in that monthly payment. Next, you have insurance. If you have a loan on a property, you have to have insurance. The lender always wants to make sure that they're protected. In the event that you default on your loan and they have to foreclose, they want that property to be in as good of condition as possible. So they're going to require you to have property insurance on the residence. So whatever that insurance amount is, they're going to take that and divide that, and they're going to take a little bit out every month so they can pay that out probably once a year for you. So on top of that, if when you've purchased the home, you didn't put 20% or more down on the property and you don't have a VA loan, so veterans can do a no money down loan as part of one of their VA benefits, but other than that, if you do a no money down loan, you're going to have what's called mortgage insurance. So this is just an extra fee. This protects the lender. It's a little bit of extra money every month that they get because you were a little bit riskier of a loan if you didn't put 20% down when you purchased. Now, some loan types, it's on the loan forever. Some loan types, for instance, conventional loans, once you get to 20%, you can request for that to fall off. And then when you get to 78% loan to value ratio, then it falls off on its own. But for instance, some like a rural development loan and no money down loan, you're going to have that mortgage insurance for the life of the loan. So remember, if you have a monthly payment and it's $1,200 a month, $2,000 a month, whatever your monthly payment is, it's not just paying down that amount of the amount you owe. It's principal, interest, taxes, insurance. So PITI is what you'll see a lot, and then sometimes that mortgage insurance. So take a look at your statement. You're getting that every month. You probably get so used to seeing it that you don't even look at it, but it's nice to have a breakdown. As a real estate agent, you want to make sure you can explain this to your clients, and as a new home buyer or someone who's already in a home that just wants to understand your statement, it's good to know where all that money is going. So I hope this has been helpful and answered some of those questions, and it can be a good resource for you in your financial planning. Thanks for taking the time to listen, and have an awesome day.